listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to the Daily Gold Podcast. Hope everyone had a great week and has a great weekend. With me today is returning guest Vince Lanci. He is with Echo Bay Partners and also writes The Gold Fix. And Vince, I mean, we could probably talk here for 2 hours. I mean, in our pre-show prep here, we're going over a handful of things that could just go off on numerous tangents and rabbit holes. So
right.
I will try and keep this and keep you as concise as possible. There's so many different things to talk about. But let's talk about silver first, because and you're much more of an expert on the COT than I am. I just look at it generally. I don't delve that much into it in detail. But this is one of the few times, I mean, I think where the commercials are net long and the speculators are net short. And I think if I remember correctly, it happened once in 2013, once or twice in 2018, and also once in 2019. So a couple of those times they were the start of some really important moves in silver. But are you looking at that? Is there something, I think there's something else that you're looking at. What are your thoughts on the silver market, and why are we talking about silver first?
Right, exactly. Well, first of all, the COT compliment, I used to drill into that all the time, but not so much anymore. But I actually, on Sundays with the Gold Fix guys, we will talk about the COT for about a half hour. So I guess I'm back into the game on that. There's a couple of things going on in all markets, or in all markets, one thing is going on. Let's get that out of the way. Just to get out of the way, in all markets, you're seeing it especially in physical commodities like gold, like oil, and like silver. You can't go with silver on that, but just to put a fine point on it, all markets are seeing a reduction in open interest in general. And that's because there's less speculators, and that's because interest rates are raised and there's less money allocated for that sort of thing. Also, and more I think acutely, is the market has kind of bifurcated with the collateral over in Russia not being available for Western deals. So that makes the people trading it trade less. So getting that out of the way, right? So that's a big problem. That's a big problem long-term for the industries. On the shorter-term side, or at least looking at the commitment traders are focusing on silver now. Silver commitment of traders is one of the few things that is really good for timing trades. So I would not be short silver anymore, and I'm trying to speak very conservatively about this. I am long silver. Let's be clear about that. I'm long silver, and I was longer 3 days ago and short gold against it, and that was just a trade. But now I'm just long silver, speculatively. So what's going on is we've all seen the commitment of traders in gold and silver, and it continually shows a decrease in open interest on the commercial side, and a decrease coinciding with commercials, meaning the producers and the banks that handle the producers' business, right? So the hedgers and their brokers. And on the speculative side, in silver, you have less longs than you normally have, and you have more shorts on the speculative fund side than normal. And that's not a new story. Like you said, we've had that happen before, and frequently it resolves higher, but that is hard to it's hard to time the turnaround, but it's easy to time the bottom if you use commitment traders that way. I'm not going to get into the minutia of that, but that's the point of it is the commitment of traders is at the extreme of normal, and it's not going to happen tomorrow, although it's probably going to happen tomorrow because I said that. What's different this time, as was different in 94 and 97 and even in 2011, is there are two things that are different. One I've seen before, the other I have not seen before. I don't think we could have it before. The first one that I've seen before is the EFP, right? And it's a term that nobody uses anymore, but the EFP represents the spread between spot in London and COMEX futures. Now, in a normal market, and I'm sure most of your listeners and subscribers understand this, but just to briefly go through it so we don't get the terms of art mixed up. The EFP, exchange for physical, is basically a representation of what's the difference in price between London's bullion and COMEX's futures. And in a normal market, and I'm saying that in quotes, in a normative market, spot in silver and gold is under a little bit less than, let's just use the 30-day future. Forget all the other COMEX futures. All you care about is the 30-day future. And the EFP would be like if silver was trading, let's say 1,800, spot was 1,800, COMEX futures 30 days out would be 1,804, let's say. And those 4 cents represent the cost of money, the cost of storage, the insurance, all these little things that have to do with the cost of carry. And from time to time, for as long as there's been metal, and it even happens in gold once in a while, from time to time, there will be a flip, and the EFP will go from under the 30-day future to over it. And what that means at the very base point is you cannot give me silver 30 days from now. You have to give it to me now. I want it today. So I'd rather have silver for 1810 right now than 30 days from now at 1805. The discount's not enough for me. I need it now. And this is represented in the market like what's a good way to describe this? Okay, so let's say I'm a jeweler, right? And I want to buy silver for use. I'm going to be making jewelry out of it, and gold as well. It's works with gold. And I say, okay, I need silver to make my jewelry, and the silver jewelry is 1,800. And then I go, well, when can I get it? And the banker, whoever is dealing my business, says, I'll give it to you in 30 days. And I say, well, I can't wait anymore. I need it now. And he says, well, I'll see if I can borrow it from someone else, hence the lease rates in silver. I'll borrow it from someone else, give it to you, and replenish it with a 30-day future. So I'm talking a little fast here, but I think that's important. What ends up happening is the jeweler says, no, I want it now. I don't want to wait for the lease to come in. Or as happened in 97, there's no metal for lease. Nobody's saying, I will lend my metal to you to make delivery if you pay me back 30 days from now. No one's doing that. So there's a physical demand in silver that from time to time, historically, spot in London will go to a premium to COMEX 30-day futures, and we'll call that the EFP is backwardating. And that's a reflection of, just to restate it simply, we need the silver now. We don't need it 30 days from now. And there's no discount that will take to let us delay it. We need it now. It's almost like food in that respect. So from time to time, that happens in silver. It happens for various reasons. It happens for it's a holiday. The guy who leases the silver is out, or there's a little bit of you hear traders say there's a little bit of tightness in silver. You have to make more than 3 phone calls to get it to relieve this backwardation. Well, what's happened now since the last time we talked is those things happen. Like you'll get silver go backwardated by a penny, 2 pennies, 3 pennies, 4 pennies, maybe a nickel, and it'll end like anywhere from 24 to 72 hours later. It'll just go back to being spot under futures. Well, now we're in a situation, and I've seen this before in 97 and 2011, where spot in London is now trading. Right now, it's about 9 cents over. So if futures are trading 1809, spot is trading 1818. So the 9 cent differential of physical being over futures is actually not insignificant. And the reason it's not insignificant is not because of how much it is, although that's important too. It's been going on for about 3 months now. And I am of the opinion, conjecture, not speculation, but not fact. I'm of the opinion that fabricators are making coins, they need rounds, and they're taking delivery, and so they're letting it. The physical bid is sticky. So why is it over the futures? Why are the banks not going, oh, I'll give it to you at 18 and I'll buy it at 1809 and I'll make 9 cents in 30 days? Why are the banks not doing that? Well, in 97, the banks weren't doing that because they were in on it. So you put your little tinfoil hat on for a moment here. They were in on it, meaning they weren't permitted to do there's an arbitrage rate in there. Buy a dollar for 50 cents type of thing. But the banks aren't doing as much as they normally do. And that's bullish, right? That's just bullish. So that informs me that it's bullish because it's indicative of what happened before. The banks they understand what's going on. The second thing, and that relates to the EFP, is when the market drops. So when silver goes, let's say from 1,800 to 1,700, a dollar, let's drop it. And everything I'm saying right now applies to gold as well, just not as big yet. When silver goes from 1,800 to 1,700, the spot market is dropping less. So silver futures go from 1,800 to 1,700. Silver spot goes from $17.99, and it should go to $16.99, let's say a penny. It's going to $18.10. So the more the market drops, and this is the whole paper silver is not physical silver stuff coming home to roost, and gold as well. The more the market drops on the future side, the stickier the buying is on the physical side. It's almost like stackers are buying dips and speculators are selling dips at the same time. And the reason this is important is because it sets the table for those big squeezes that you're talking about. Those big squeezes the catalyst for them in the past, there's been 2 catalysts, and we might be starting to see one now. In the past, there have been 2 catalysts. One is the funds or the speculators get too short, and they might be getting too short now. And once they get short, somebody pulls the rug out from under them. And in 97, it was Buffett saying, you know what, I think I want that silver. I'm not going to wait for it another 30 days. And that caused a short covering rally. In 2011, it was JP Morgan pulling the rug on the big silver futures locals who were short the fronts and long the backs. They had spreads on the wrong way, and so they got killed. So I don't know who the sap is at the table this time, but the EFP has been trading, first of all, inverted for 3 months now, and it's been sticky. And that says that the buying, it can go away, but the buying is not going away yet. It's been there for an awfully long time. Now, we can all get comfortable with that. It's like, oh, we get comfortable with that. Silver's still not going anywhere. Gold's not going anywhere. They hate us. Well, there's a new thing. And again, I'm not trying to have people go out there and panic and buy silver, but, I'm probably going to be buying more physical soon in silver, not necessarily gold. Not anti-gold, just saying I think silver's a trade. The thing that I never saw before that we're running into now is before these other squeezes happened that in my database, that was before the SLV contract. Well, now we have an SLV contract, and you can short the SLV contract. So the SLV contract, to short it, right? Most of us are physical guys, right? But looking at stocks, to short it, you have to borrow from someone else to short it. And the lease rate to borrow someone's shares to short them in the market historically is about 25 basis points, less than a percentage point. Well, now it's over 6%. And that's happened recently in this run-up. It's spiking again. And if I were a person who wanted to get long silver, and by the way, this is how it happens in all metals. If I want to get long silver and I think it's going to go up, I buy everything but silver futures. Because silver futures is the price that everyone looks at. Silver futures, gold futures as well, is the tail that wags the dog. And so if there's an EFP that's backwardated, that's bullish. If there's open interest that is heavily skewed towards the commercials not being as short as they usually are, that's bullish. Now the SLV, and I haven't looked at GLD yet, but the SLV open interest is getting very hard, not open interest, the SLV borrowing lease rate for shorting is getting relatively expensive, kind of like it did years ago. And so when you put these three things together, it could just be a trade, meaning you're long silver, you make $1 on it, and you get out. But typically what happens in these things, if one of these trades is whoever's doing it, if someone's, quote, doing it, being brought to fruition, then what ends up happening is they come back and they do it again because there's always someone to hurt a second time, like the meme stocks. So my feeling is, I'm starting to sound like one of those people that I don't like anymore. My feeling is you have a large short open interest in silver futures from the short-term speculative momentum type sellers. A lot of these are CTAs. They're commodity trading advisors that have sold silver and gold. We'll touch on gold next, right? And gold because they think we're going to have a recession, and so they don't want to sell their stocks. So their CTA advisors tell them to sell something else, sell gold, sell silver. And that's what they do. But they get lopsided. And the rally in silver could go from 19 to 22. Like, that's what could happen. And then it might be over then. But that's what could happen from the CTAs. The CTAs are so short and the momentum funds are so short that there could be a spike above $19 to $22. That's the way it is. Now, historically in the metals, and you know this, after you get one of those rallies, the funds in other markets will start to reverse and get long. But they don't do that much in the metals anymore because they've been so demoralized, only leaving people like us to buy it. So, which kind of brings me. So when you look at the EFP, when you look at the short open interest CTAs, and you look at this new SLV thing that Bob Coleman had brought to my attention, you start to say, well, why is somebody so short so many contracts at Bank of America, right? Why are the metals this low? So, and I'm coming to the conclusion that it's a simple conclusion, and it's one you've heard before. But it will take forever to play out. But I'm coming to the conclusion that that there are big buyers in the market. They're buying to hold it, and we are coming into a monetary reset. That's happening. Everyone's talking about it, but it's real. It's happening right now, and you need to have specie, which is physical gold and physical silver, primarily gold actually, for money in the future. That's just going to happen. Secularly, that's going to happen. So we are setting the table for a $3 move in silver. I'm not saying it's happening tomorrow, but I am saying that it could happen soon. I'm not sure where it will come from. I'm not sure what will trigger it, but it can happen. Now, does that help a little bit?
Yes, it does.
Now, gold is what we were talking about before, and I guess that's the rub here. I've noticed in the gold story is a little bit different, and I like gold I like gold to own and silver to trade. That's the way I operate, right? So generally speaking, I'll buy and hold gold, and generally speaking, I'll trade silver, kind of like the more volatile cousin. But with gold, and I can say this with a high degree of confidence, if there's someone out there who's got anxiety about the price of gold, I'm saying this to you like in earnest, don't. Because in 5 years, and we're not talking about 5 days or 5 minutes, we're talking about 5 years. If a percentage of you, and I'm not talking about miners either, because I don't claim to know that. In 5 years, gold's going to be significantly higher. Here's what I believe is going to happen over the next 5 years. And the reason I say this, keep saying 5 years, is because the price today doesn't matter. The price today is not the value of gold. The price of gold today is, $1,750. The price of gold in Shanghai is $1,800. How is that? Well, they have more demand there, and you can't sell it to them over there, but someone else can. Well, that's what mercantilist business models are like. And eventually, when the dollar is either broken or bifurcated globally, things will trade in their proper price. The metals are cheap in dollar terms. They don't reflect genuine demand. They reflect artificial supply. I mean that. Okay, so gold. Specifics about gold. Since Basel III went into effect, and even more since the J.P. Morgan, Citibank derivatives fiasco went from the FX part of their balance sheet to the gold part of their balance sheet, where it's supposed to be. I've noticed, you look at the chart, if you're a chartist, right? Maybe if you're a technician, it's like you see gold doing this, you see silver doing that. I look at the gold-silver ratio a lot. And I look at it not because I'm technically trading it, but because if I see a pattern, a very simple, like moronic pattern, something even I can understand, like a 45-degree angle, which doesn't occur in nature, or an orderly move on a daily or weekly, I pay attention to it because that is, in my opinion, I've seen it before, I've done it before for very small minutes. But if you need to buy gold and you're trying to accumulate gold and you're a central bank and you've been told that you can't carry as much paper gold as you used to, what do? You sell silver to get the price of gold down. So you get silver drop 10 cents and gold drops $1. And you buy as much gold as you can, $1 lower. And you keep doing this until you get enough gold in, and then you worry about your silver problem. If you look at what's happened to the gold-silver ratio over the last 3 months, it's gone from like 80 to 96. Now it's back off to like 91 or 92 now. But it has had this, we'd have to pull a chart up to show that. It has had this slow, orderly, methodical march. Even while gold's having a $20 range and silver's having a 50-cent range, the march has been higher. Silver's down 10 cents, gold's down $2. Silver's down 20 cents, gold's down $4, and less and less and less. So gold's becoming more sticky on the downside than silver in futures. I think what that means is, and I'm very confident in this, but you can't prove me wrong until it happens. It's going to happen. That central banks are continuing to buy gold, either because they just want to buy gold or more realistically, they need to insure two types of risk now that are related but not the same risk. One is the euro. If you're in Europe, you need to have gold because the euro is more and more in danger of debasing because of the European, Ukrainian, Russian thing.
It's on its way to becoming monopoly money.
Yeah, exactly. It is, and there's no way out of it unless the Fed rescues them. That's exactly it. And I'm not even negative on it. Like I thought it would happen within 3 years of '93 when they started the whole project. So how wrong was I on that? But it is definitely on its way to becoming monopoly money. And the difference between, well, anyway, Europe wants gold higher. We get into why some other time. And but at the same time, they need to buy as much gold as they can. The Eastern European countries are buying gold. Asia is buying gold. I mean, everything out there is telling you it's happening. We have been in this soup, this stew for so long that we're having a hard time believing the good news that's out there. The good news is out there. It's happening right now. All the things that we talked about are truly happening right now. Somebody stood up to the U.S.'s dollar dominance and said, no, we're going to have an alternative currency. And we don't know what that alternative currency is yet, but I guarantee it will be weighted with gold, or if they don't want to weight it in gold because they don't want people to think about gold that way, they'll weight it in a currency that is backed by gold, kind of like the Swiss franc used to be. That's the first thing that's going to happen, right? And so that's why you have to have gold on your balance sheet. If Russia never talks to the USA again, they're still going to buy Levi's jeans from us, and we're still going to buy, beluga caviar from them, or more realistically, you know how it is. We'll be buying our palladium from them, and they'll be buying grains from us or something like that. And you will need money to do those international deals. And if we think the ruble's worth shit, and they think the dollar is too much of a bully's currency, then we're going to have to agree on something. What does everyone have? Everyone has gold. What does everyone value? Everyone values gold. What does everyone want to use? I mean, even if they want to use Bitcoin, they can't. You need to have enough to trade in it. And so the thesis that I came up with about 6 months ago on gold is I'm no longer worried. It's happening. It has to happen. And we're having a monetary reserve currency change. The world is going into a multipolar or at least bipolar reserve currency status. We're not necessarily going to have the yuan replace the dollar. We could just actually have everyone go to their separate corners. So I have been very friendly to gold and very negative on silver related to each other over the last 4 months. And that has borne fruit. Well, anyway, it provided fruit, right? And this week I reversed because I think too many people are short silver. So I just gave you a little rambling thing there, but if I just want to say, if you're looking at the day-to-day price, and I'm not a hand holder, but I want to say this, if you're looking at the day-to-day price of gold, the metal, don't worry about it anymore. It's trading higher everywhere but on the COMEX. And it will trade higher on the COMEX eventually. How will gold trade higher? They're going to remonetize it. And I don't know how they'll remonetize it in the U.S. It may be something like, and I'll have to give Tom Luongo credit for mentioning this. The gold market is historically, and I knew this, but I didn't put it together like he did. The gold market historically is tied to the bond market. When gold was money before 1971, it literally traded on the desks with the bond guys. The bond guys traded gold. It wasn't the gold desk and the bond desk. It was the gold was on the bond desk because it was money and because interest rates were tied to gold. Well, I think, and this is, I can't take credit for this idea, but it makes complete sense. Whenever a government wants to change with the least amount of stress, what does it do? It kicks it down the road. It delays it. It slows it down. How would you do that in gold? Everybody's been talking for years about, gold's going to go to 10,000, 20,000 if they were to remodel. You can't do that. You kill the world if you do that. You don't just kill us. You kill the world. What can you do is you phase it in. In any well-run business, I'm not saying we're well-run, you phase in change. It's like actually, here's an example of things not being phased in properly. We're going to go electric vehicles. We're going to go 5% a year for every year for the next 30 years. That's us going off of carbon, right? Well, that's fine. But now you got the government saying something like, we're going to go electric in 5 minutes. That's stupid, right? I don't think they're going to be stupid with gold. I think they're going to remonetize gold by attaching it to a deferred bond. And this is maybe novel, but it's really not. It's really old school stuff. So it's kind of like the government's going to issue 30-year bonds, and those 30-year bonds will mature in gold. And when that happens, you'll have like a gold-based bond. And the U.S. government, what the U.S. government does, and it's actually quite brilliant if they do it this way, what the U.S. government does is the U.S. government carries its gold on its balance sheet at, $45 an ounce, something like that? I'm not sure. Do you know?
Yeah, I think it's really
it's ridiculously low, right? It's whatever the price is. They carry it on their books at their cost, which was, whenever they confiscated it a billion years ago. So if they were to let it float at its price above their balance sheet, then you would have our inflation problem would be over, but the worlds would be just beginning. But if you attach it to a bond and say, we're going to give you the gold, say it's a 10-year bond, 10 years from now, 20 years from now, you buy this bond from us, the certificate is good for gold. We're going to give you gold 20 years from now. What you do is you remonetize gold slowly. You allow for a transition from one to the other. And you satisfy the impulsive pent-up gold demand now. I want the gold bond 20 years from now. And the U.S. government what the U.S. government does is it allows it to mark its gold to a higher price based on the bonds. It allows the competing currency to the dollar start to get out there with this bond product, because now you have an arbitrage that can be created. And it solves the international trade problem for beluga caviar versus Levi's. So gold's going to be remonetized. It could happen as soon as 2023. I think it's going to happen in like 5 years. I think my current opinion is I did not know how they would do it, but this is how they're probably going to do it. They're going to create a debt instrument, a bond, and they're going to raise money with the sale of their gold in the future. And that's what's going to happen. That's like, you can take that to the bank, I mean, find me if I'm wrong, right? I mean, it's going to happen. That's how they're going to remonetize gold, because it solves three problems. Number one, it answers the debt problem, because we carry gold at cost on our balance sheet. Europe doesn't. Europe carries gold at the price that's trading. And so Europe needs the price of gold to go up even while they're buying it. We carry gold. That's our insurance. We carry gold on our books at whatever it's $40, $45. When we let the price of gold go up, we don't want it to go up all at once for the world. We want it to go up for us on our bookkeeping, and using bonds we can do that. And that's the first thing. It solves the debt. The second thing is it remonetizes the debt. Second thing is it creates an alternative to the dollar. And the third thing is it's the answer key to whatever Russia and China and those other guys are doing. And so, as a patriot who has a lot of faith in our financial engineering skills, I think that's what we're going to do. That's what's going on.
Okay, let's zoom back into the near term and the next economic cycle.
Sure.
Because, I mean, you've been writing a lot about Zoltan and deciphering his work and his analysis. And I've seen some other people mention this. And so it seems like it appears that the next cycle, and probably for the next decade or two, we're going to be shifting away from we're cutting rates down to zero, printing a lot of money, into like that's not going to be the and stocks and real estate will go up. The driver is going to be like we're going to have basically the government fiscally is going to support the economy, and they'll bail out whatever needs to be. Student loans are getting bailed out. Whenever the Republicans have power next, they'll bail out who they want. So it just, correct me if I'm wrong, it seems like that's going to be the drive. I'm not, and of course, the Fed, they'll have to cut rates in the next year anyway, but we're not going to see them. They're not going to cut rates down to like 0 or 1%.
Right.
I mean, am I wrong about that? How is
that?
No,
I mean, you're so right about that. It's crazy. And that's the quick background is, about 6 months ago, Posar was saying there's going to be a new monetary order. Fine. Okay. All right. And then 3 months ago, he said, you guys had better get used to it. We're not going to be lowering rates. And nobody believed him. The market rallied again, And then last month, the most recent one, I think I definitely wrote on this one, right? I got something out the next day because it just made sense to me. He basically said, and he really put a finer point on it. Everything, here's why I'm excited. I'm excited because what he's describing, I'm seeing before he's describing it. Now, I'm not deluding myself. You wait. You say, am I right? He's going to write about this next. And so he's not God, but the point is, when you look at what he's written about this topic that you're talking about right now, and what just happened at the Fed and at the fiscal side, it makes sense. And here's what's going on. Number one, the first point you made is they may be cutting rates tactically from time to time, but we should not be expecting. That's my phone. Sorry, we should not be expecting.
That's Zoltan, right?
Yeah, I wish, right? Exactly. He's probably telling me to shut up. The funny thing is, he's probably employed by them to get these messages out, and if he gets someone to listen to him, you know what I mean? So the Fed. All right, so what happened? I just lost my train of thought there. All right, so we're used to, right? Here's the point that you were making is that we have been almost trained, especially since the great financial crisis, 2009, to expect V-shaped tops in interest rates. It goes up, it goes down. It goes up and something crashes and they have to fix it, right? And so maybe not you and me, but the stock market in general as a structure keeps expecting this pivot, the Powell pivot. And he had been warning us for the last month and a half that it wasn't going to happen, and the market didn't believe him. So you have Powell warning about this pivot that's not going to come anymore. To your point, he was warning that just because I raise rates doesn't mean I'm going to lower them when it's over. We could go sideways a lot longer in rates. He's implicitly saying that. And he was also saying, I'm very serious about inflation this time. I'm not going to tell you guys why, but I'm really worried about it. So he's saying those two things, and the market's semi-taking him seriously, and then it stops taking him seriously. And then Jackson Hole happens. And he comes out, and I haven't even gotten to the fiscal side yet. That's a disaster. He comes out and he says, this is what I told you I was going to do. This is what I'm doing, and I'm going to keep doing it. And he walks off the stage on an 8-minute speech that's supposed to go 30 minutes. And in that moment, I went, oh, he's doing exactly what Zoltan said he would do. Zoltan was like, Zoltan's not a genius. I mean, he's probably a genius, but he's talking to these guys. Zoltan said that the Fed needs to, A, raise rates and be determined about it, and B, make the market guess more and stop spoon-feeding them. And that was his first example of not spoon-feeding the market. Volcker didn't used to come out and say anything at all. He would just raise rates and tell you that he did it afterwards, stuff like that. So the market saw Powell talk for 8 minutes, not equivocate, not handhold, not spoon-feed everyone, and they went, oh, shit, this is tough love daddy. And the market sold off. So to your point, to the point that we're trying to make here, rates will go up higher for longer. There's going to be a but, right? Rates will go up higher for longer than you think, and the Fed will not stop raising until they see. Now, this part's my opinion, but it's based on other people's knowledge. Until the Fed sees 2 or 3 straight months of extremely weak inflation. So if the GDP is negative 20, I'm exaggerating, right? If the GDP is negative 20% and unemployment's 4%, then they're going to keep hiking. They don't care. They just need to get inflation under control. And the reason for that is because they know damn well that the only part of inflation they can't control is the demand side by making things hard to get money for. They can't control the supply side. And this supply chain problem that we're going to have, as you mentioned, 10 years, 20 years, it's definitely 10 years at least, right? It's going to be chronic. We're going to be rebuilding our supply chains. We're rebuilding our infrastructure. We're going back to an economy that is rebuilding itself. Like before World War II, we had to rebuild our economy. And that was happening, and the war actually helped us, if you think about it that way. We need to rebuild our manufacturing. And manufacturing these days isn't just steel, it's, computer chips and stuff like that. But to come back to what you're saying is the Fed is more determined than ever to raise rates and really get inflation under control. Number one. Now going back to what the people who think they can't do it are saying, and it's also valid. They're saying, yeah, but something's going to break. And what's going to break? Well, it's not going to be a bank this time because they've seen that before and they know how to solve that. Maybe it's an industry in the U.S. I don't know. I haven't seen it. You're probably going to see, if something's going to break, obviously the easiest thing that we can see is stocks are dropping. If the S&P goes to 3,500, I would say, okay, let's start to pay attention. If the S&P goes to 3,200, it's probably just a buy because then the Fed will have to start hiking, stop hiking. I think that unless you have a credit event, some company that beyond my pay grade goes belly up, or some industry, or the stock market goes to 3,200, they'll keep hiking. That's what I think. They will keep hiking until the stock market gets below 3,500, or unemployment gets, believe it or not, above 6%. So next quarter, to your point, if unemployment spikes to 5%, maybe they won't raise 75 basis points. Maybe they only raise 50. But like you said, they're going to start managing it. They're going to start doing it less or more or less. And the long-term path, now we come to the fiscal side, is the U.S. needs to spend, I'm not saying I agree with how they're spending it, but the U.S. needs to spend money fiscally, right? They need to spend money on rebuilding things. And of course, if you're looking for votes, they need to spend money on student loans being forgiven. I don't think that's a good idea to do. But I'm not the president. I'm not running the country. But fiscally, we're going to be spending money, and those expenses are going to create inflation, right? If the government comes out tomorrow and says we're buying 50 tons of steel to rebuild a bridge, right? To simplify it, or we need to rebuild this bridge. We're buying 50 tons of steel. Well, the price of steel goes up. That's inflationary. It makes nails for you and me too expensive to buy anything with steel in it. So what's the Fed going to do? The Fed's going to squash demand by raising rates. The Fed will be putting its foot on the brake while the fiscal side puts their foot on the gas at the same time. And that's a good analogy.
And they're not
what happens when you do that to a car?
They're not going to slam on the brake.
Yeah, exactly.
They'll just
tap the brakes.
tapping and raising rates slowly. If the economy starts weakening,
right?
They'll
let it coast a little bit. Yeah, no, that's exactly.
If the economy's really strong, they'll raise aggressively.
Yeah, exactly.
They should have been doing in 21.
You know it. That's what they should have been doing. They should have been front loading the rates back then. Now they're doing it back here. But that's what they do. They are at the banking level, at the central banking level. They're just not. They're not honest, and they may be lying to us. They may just be lying to themselves. I mean, if I was in a central banker's position, and I had some government person who didn't understand what they were doing say to me, do we have to raise rates? I mean, well, if I want to keep my job, I'm going to say, well, maybe we don't have to raise rates. You start thinking about your job and stuff like that. And those are the things that weigh on the banker. But your point about, you know what's a good parallel for this whole brake gas thing? When Clinton got into office, after Volcker did his deeds and Reagan started to turn us around, when Clinton got in office, the central bankers, Bernanke and et cetera, they had the opposite. We were pulling back on fiscal spending, and Bernanke could gently lower rates. So your analogy of tapping the brake, that's right. And on the way down, they tapped the gas. They didn't really have to lower rates aggressively because the economy was fiscally, we were getting more efficient, more supply chain stuff was being fixed. Technology was making things more efficient, what have you. And the Fed didn't have to. The Fed was like not hitting much gas. The Fed, like for example, inflation would drop to 4%, and the Fed funds rate was still at 5%. They chased the deflation down. Now they're going to, by tapping on the brake, chase the inflation up. So we're going to have a slow, if they do it right, we're going to have a slow, orderly debasement of the currency. It has to happen. You're right. It's about tapping a brake because that's what you can control. The foot on the gas is Biden's problem. And I actually think that Powell might be trying to do that now when he's making all these "I can't be politically bribed" type of statements. I don't know.
Okay, Vince. I guess last question here before we close. So the Fed in this cycle, you've already talked about what will force them to pivot, and
right.
You did say you think they'll have to cut. I don't know if that was in our pre-show discussion. I can't recall. And I think last time, a couple months ago, you were talking about after November, like you could. That's when you could see the Fed stopping. What's your? I know it's very difficult to predict, but do you generally think that it's going to be November, December when they stop?
No, okay. That's good that you bring that up because a lot of guys don't hold. My dog's about to start barking. A lot of guys. Shh, hold on. All right. So that's really a good point. Here's what that reminds me of. Back then, I said the Fed will cut rates after November. Now I'm saying the Fed has an opportunity to stop raising rates after November. You know what I mean? So the reason I use November is because it was an election. And Powell wants to show that he's not influenced by. Sorry about the noise. Powell wants to show that he's not influenced by the politicians. And so Powell can be more friendly to the politicians after the election. So between now and then, I don't think he's going to reverse and start easing. But I still believe that it's kind of like he's going to stop hiking in October or November, and maybe he'll have 1 month where he does nothing. And then, like you said, then he'll say, okay, are we titrating this? Are we going to start lowering rates 25 basis points to raise it 50 basis points next month? Or are we just going to start lowering it? And that depends on the market. So yeah, I think take them seriously for another 2 hiking periods. And then I think it gets more unknown. That's how I look at it.
Okay, very good. Let's leave it on that note. I mean, a lot more to discuss, but we'll have to get to that next time. So, Vince, thank you so much for coming on today. Really enjoyed it. And finally, where can our listeners go who want to follow you and subscribe to the Gold Fix?
Well, the Gold Fix is at goldfix.substack.com, and people signed up last time, and I appreciate it. Signing up free is fine, but if someone's interested, there's a lot of good stuff that the premium guys get. So if you sign up, we'll set up some sort of a discount for your community like we did last time. But you can just sign up for free there and just try that out. The more brave people can look for me on Twitter at Lanci Pictures, which frequently gets suspended. And it's not a badge of honor. It's not like I'm some rebel. I make jokes like, like I don't like cats. So I'll say that my cat's going to kill your dog or something like that, and they'll suspend me for causing self-harm. So you can look for me on Twitter at Lanci Pictures, but I may not be there from day to day. Or you can find me on Goldfix Substack.
Alrighty. Thank you so much, Vince. Have a great weekend, and we'll speak again in the next month or so.
Thanks, Jordan. Thank you very much. Great to see you again.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.